Hello Internet, this is Marko Yamashita. As the trading week comes to a close, we're taking a look at the stock market movement of Cover Corporation. In a new segment introduced by my channel, we're taking a look at HoloLife's parent company to understand the recent price movement and feel the pulse of Japan through their investors instead of a Yahoo chatbot. HoloLife's Cover Corporation has seen some extreme swings with their stock price over the past few days. On August 9th, shareholders massively sold off their shares after the release of Cover Corp's Q1 financial report. Despite hitting both of their forecasted goals with their total revenue earnings and matching earnings per share, a much deeper look at the company is needed to understand the recent reversals. While I'm in the process of completing a more in-depth look at Cover Corporation, a brief look at certain key components can certainly be examined right now. The first focal point I want to bring to your attention is the negative year-on-year operational cost results. This negative outcome reflects costs that are for running the company have increased from the same time last year. While many considerations are certainly involved with this increased cost, Yosuke Kaneko, CFO of Cover Corporation, provided some vital details regarding this very subject when he did a Q&A for the shareholders back in May 13, 2024. We operate the studio at full capacity throughout this year's budget period, unlike the beginning of the previous year. As a result, the degree of contribution of fixed expenses, such as operational staff, is increasing. As for the fixed cost element recorded as cost, we plan to start the amortization of software assets, which is the accumulated development cost of the metaverse, starting around October 2024, as shown on the slide on HoloEarth. In addition to the depreciation and operating personnel expenses of the studio, a certain ratio is expected to be accumulated on the cost side. On the other hand, we assume the marginal profit as a whole will continue to improve through an improved sales mix. The increase in operational costs attributed to production through the studio facilities and game development seems to be contributing to the case of the cost increasing. However, while being fully aware that the increased costs would affect net profit margins, it appears management decided not to be proactive, something that shareholders got pretty used to having them do in the past. We can interpret this as such considering the bottom lines still translate to the reported revenue falling within the forecasted range. As a result, Cover Corporation's income report for Q1 came up short when compared to the forecast from the International Financial Information Service, or IFIS. And since financial analysts carry a lot of weight, investors quickly soured on Cover Corporation and triggered a minus 12.08% sell-off. Now, one might ask, why has their stock been able to bounce back so quickly? And the answer is value. Besides the global sell-off from last week, combined with the recovery of this week, shareholders that bought during any of the other three significant dips would have had at least a 10% increased return of investment. And the dip provided investors with a significantly discounted entry point as well. While buying the dip is always a welcomed opportunity for investors, the downside to this is you either have to go all in and buy the stock and then wait for it to rise, or you buy options on the stock and play the game of wait and see through puts and calls. Both are common practices for many investors in the market. However, when you look at the stock performance, a noticeable and concerning trend begins to develop. Besides self-devaluation, as seen here, where Cover has lost almost half of its value from November of last year, this previous peak falls in the assumed launch window for HoloEarth. I'm currently working on a more detailed evaluation of that project, but what I can say now is Cover Corporation is banking big on microtransactions to help cover the costs of loans taken and servicing the game. What's even more troubling is HoloEarth, a multi-billion yen project, was completely absent from the Q1 report despite being heavily questioned on its production, its future, and its timeline during the annual physical Q&A that happened back in May. With only 57 staff members working on the project and the metaverse job positions always being sought, it's difficult to know whether the game will be launched before it's ready, like so many other AAA titles, or it will be properly developed by launch date. In closing, allow me to say that while I've been critical on several topics in this video, my criticisms are given precisely because I want Cover Corporation to succeed. I wouldn't invest money into this company otherwise. I can see what Yago and his staff are trying to achieve, and I think it's a worthy venture to pursue. They have top-level talent, a reach within a unique demographic, and seemingly found a winning formula with the growing of an international audience. These criticisms are given because, despite my personal feelings, I see plenty to be concerned about. Shareholders have no means to profit off this investment and this company long term because you have to cash in on your shares in order to get a profit. Share prices seem to rely mostly on financial reports to give it a boost in a positive direction. And one bad report causes a devaluation, this time over 12%. Operational expenses are of particular concern since costs and expenditures have increased, yet they seem to be lacking staff for the HoloEarth project. While the last couple of financial reports are based on company growth, it is critical to realize that revenue and investments seem to get devoured at an alarming rate just to maintain its current thin margins. There's little doubt Cover has the means to champion this growing industry. That said, the amount of investment placed into upcoming projects, plus the knowledge that loans and net revenue will be utilized to pay for HoloEarth and its continuous operating expenses, you begin seeing the erosion of net income, thus capping the amount of cash and deposits the company has to explore new business opportunities. These can all unsettle an investor who is likely to invest in a more stable company that can provide a constant return on investment. Hopefully, we will see Cover address some of these shortfalls in the months to come. Thank you everyone for watching. If you've reached this point in the video, I hope you have a fantastic day. Please remember to like and subscribe if you want to see more content like this. Have a great morning, afternoon, or evening, whatever the case may be for you. Until the next time, this is Marko Yamashita signing off. Peace.